me great pleasure to bring on board Ridham Desai of Morgan Stanley to talk about markets, valuations, and more importantly, fitness. How is he staying fit in this kind of a market and in this kind of an environment? Ridham, fantastic to have you back. Thank you for joining us. Well, the moot point is the conference, but I'm tempted to ask a very simple question. Why are markets outperforming and markets are still holding on so smartly at a time when we know that the impact of the second wave is going to be a very big one on the economy, on the demand, and also on the sentiment?
Well, actually, hi Nikunj, hi everybody. Good morning. Glad to be back on ET Now. I actually disagree with you. I don't think the impact of the second wave is going to be that large on the economy. Yes, unfortunately, very grimly, it was very difficult at the human level. And the human life loss was certainly a lot more than the first wave. But the economic loss, conversely, was a lot less. There is one measure we have, which is the Oxford Stringency Index, which measures how stringent were the lockdown measures. That number was at 100, which is the maximum reading. Last year between April and July, India had the most stringent lockdown relative to other places on the planet. That stringency index went up to a high of about 85 this time. So it was a lot lower than last time and for a much shorter period of time. So it's not going to last for 4 months. If anything, we're coming out of the lockdown. So the economic impact is meaningfully less, and it's only for a very brief time. In fact, I would actually further add that last year, businesses were not prepared for a lockdown. And as a consequence, they actually suffered loss of revenues. This time, businesses were well prepared. E-delivery models were already set up. People knew how to transport things. There weren't actually much restrictions on goods. Manufacturing activity continued, infrastructure activity continued. So Nikunj, I would say that the economic impact is a lot less. And just, final point on this is that the market saw this. The market saw this pretty quickly. In the initial stages when the wave erupted, the market did start to correct and Nifty went close to 14,000. But very quickly the market realized that the government is not interested in clamping down the economy and it recovered. So, and we've also learned from successive waves from around the world that all the economic impact coming out of COVID waves is transient. It doesn't actually cause permanent loss of demand. If anything, actually demand comes back with greater force once the wave dies down. And I think the same thing will happen in India. As this wave dies down and hopefully we don't get a very big third wave, people will be very eager to travel. People will be very eager to undertake leisure activities, go to the theaters, go to the restaurants. A lot of this activity will bounce back far more strongly than the way it fell during the stringency period.
That's a great point. So can I say, and Ridham, I've got lots of questions for you. I'm glad that we have some time today. We'll have an extensive chat. Ridham, can I say that the shape of the economy because of the pandemic is going to change in a rather meaningful manner, which is that corporate balance sheets are getting better and the retail balance sheets because of saving, because of drop in disposable income is going to change. And that's a very meaningful change which we need to perhaps accept, and that is what markets are also indicating.
I would agree with you, Nikunj, on the corporate balance sheet. It's less to do with the pandemic. It's the healing that happened pre-pandemic. A lot of healing was already happening, and the banks also have bolstered their balance sheet along the way. So corporate balance sheet look a whole lot better than they were 3 or 4 years ago. The retail balance sheets is transient. The rise in saving pool that has taken place during the pandemic months is all going to come out and be spent. And retail leveraging actually, I think, will pick up pace as well. So I don't think the retail balance sheet has changed. Not that it was actually in a bad shape either, but I don't think it has gotten better during the pandemic on a permanent basis. The corporate balance sheet certainly looks a whole lot better. We measure the balance sheet recession, which is what we went through for almost 8-9 years. It was a balance sheet recession as well as an earnings recession. And that is when companies are earning less than the cost of debt. A lot of that balance sheet recession has reversed now, despite the pandemic. So we are coming out of that recession. So it will be a very strong bounce back from corporate India. And also, Nikunj, you should see the policy change that has taken place over the last 2 years. So you will actually go back pre-pandemic and see what happened in September 19 when the government surprisingly cut corporate tax rates. Since then, the government has done successive policies through the pandemic to boost the share of profits in GDP. So I think the environment is very conducive for a profit boom. I would reckon that corporate India could compound earnings at over 20% for the next 3-4 years, with a little bit of support from the world and the current policy environment if it doesn't get reversed. So that is not priced into stocks, which is why stocks have got such a big bid, because the stocks will struggle to price in such a medium-term reversal in profit growth. Stocks, I think, see what's coming in the next 12 months. That may be more or less in the price, but not what's coming in the next 3-4 years.
Ridham, you've got lots of proprietary indicators, and those indicators are based on behavior, valuations, and also earnings. What are your proprietary indicators telling me? For the benefit of our viewers, those are proprietary indicators which Morgan Stanley as a firm uses to indicate the market mood and the market valuations and the market forecasted returns. Ridham, what are indicators suggesting?
So in summary, Nikunj, all the macro indicators are very positive for stock returns. So whether it is stability, whether it's growth, they're all pointing towards higher share prices over the next couple of years. The cross-asset indicators, which is what the currency markets are doing, what the bond markets are doing, are also positive. Liquidity indicators are now neutral. They were very positive for the past 1 year, but now they have turned neutral. Mostly global liquidity indicators are now more neutral with the backup in the 10-year yield in the US. And we'll come to this discussion a little later, but I think that's the key risk to the market, that liquidity indicators turn negative. And the source of that would be a surprise move from the Fed, because inflation in America becomes more persistent. I don't think it's a 2021 event, but it probably could be a 2022 event. So keep a watch on that. Valuations, the market valuations are no longer suggesting that we have more upside left in the near term. We may have more upside left in the medium term, but not much in the near term. So valuation is one negative indicator. Sentiment is actually quite okay. So that is not showing much exuberance, surprisingly. A lot of our sentiment indicators are still moving up, and they have not hit what we would characterize as sell zone. So overall, on balance, when I combine all of these five, I think the outlook for the market is positive. Now, the valuation metrics, I think the challenge there is when we compare with history, earnings and book values are very depressed right now. And because they are so depressed, valuation indicators may look a little bit rich, which is what is happening. I think if you normalize them, which we don't normally do that when we are looking at this, but if you normalize earnings and book, then I think the valuations also will look okay. One more thing I'll add here, and this goes back to your first question. If you deflate equity share prices by gold, by inflation, by earnings, by book value, markets are actually not so rich. Yes, they have gone up a lot year on year, but over a 3 to 5 year period, they are still not, in territory which would make me worried. There'll be a lot more upside left on share prices relative to all these macro and market indicators. So I do look at it relative to gold, inflation, earnings, and book, and I draw some comfort. Of course, they're not as cheap as they were last March, nowhere close to that cheap. That was an oversold territory. But we're not yet in overbought territory.
The naysayers are saying that interest rates will go higher, which means valuations have to come down. The naysayers are saying that inflation is not transitory, and naysayers are saying that one day central bankers will be forced to bite the bullet on where the balance sheets are going. How would you defend that?
No, the naysayers are all right. The question is when this will happen. Obviously, it's going to, rates are going to go up. They'll not remain low forever. The fact is that the response to the pandemic from policymakers around the world has been unprecedented. We've never got such synchronicity across geographies and between central banks and governments ever in the history of the world, not even during World War II, definitely not during GFC. yes, there was a response, but the scale of the response here is almost 3 to 4 times bigger than ever. So all that money is floating in the system. It's finding its way into equity share prices. Eventually, the economy will demand it, and that's the meaning of more persistent inflation. Now, this is going to be a very tight game because the Fed is continuously telling us that it has greater tolerance for inflation. Remember, post GFC, inflation never really came back in the US and remained below the Fed target of 2% for all that while. So the Fed now is saying it has greater tolerance to let inflation go above 2, so that they are confident that now we are dealing with 2% plus inflation. And when you do that, maybe inflation goes to 2.5 and the Fed falls behind the curve. And Nikunj, you know this, when the Fed falls behind the curve, or when the market starts believing that the Fed is falling behind the curve, it is quite possible that stock prices take a big knock. Now, would that be the end of the bull market, or will it be a steep correction? At this moment, I think it will be the latter, because I think the growth cycle will still be assisted. But if inflation goes out of control, then things could unwind very quickly. So we have to keep a watch on that. It's clearly a risk factor. I think the debate is when. Is it a 2021 event? I probably don't think so. Is it a 2022 event? It is quite possible. And that could be a moment of reckoning with the sharp correction that may happen in share prices.
Okay. I'm sure you've not been asked this question before, but I've asked this question to Mr. Jhunjhunwala. So let me throw this question at you, which is that imagine if the bull market is like a train journey from Churchgate to Kandivali. Where do you think this bull market has reached?
Churchgate to Kandivali or Borivali? Let's take Borivali. I think we are at Bombay Central. I think we're at Mumbai Central. Okay. What did he say?
Why do
what
you
was
think
his response?
Well, the other side of the train track, which is, he said we are at Churni Road.
Okay, so yeah, we're pretty much on the same page there. Now, I would agree with him actually that I think these are very early stages of the bull market. Now, whether it's Churni Road or Mumbai Central, I think that's not really relevant. The point is, this is still an early stage of the bull market. Nikunj, you have the history in your head. You've been here for long. It's more like 2004. It's not 2006 yet. See, 2006 was when things started getting a little heady. And in 2007, we had a runaway rise in share prices, all preparing for a fall. I think we're more like 2004. So we have more legs to go on this.
If this is indeed the same playbook like 2004, then are we in for a repeat of the same pattern, which is consumers will underperform massively and industrials and cyclicals will outperform? Because that is the case you are also making if I look at your construct of the model portfolio.
Yeah, I think domestic cyclicals will do very well. See, we should not underestimate the shift in government policy that has taken place. For almost 13 or 14 years, the emphasis of policy was to boost the share of wages in GDP. It didn't quite work out. The reason is because India has excess labor. If you peg wages too high, then you create inflation. And then to counter that inflation, you lift interest rates and you invariably run higher real rates than required and you suppress growth. The other way around, because India has uneven supply at best and supply shortages at worst, is to actually boost the investment cycle. But in order to boost the investment cycle, you need to lift corporate saving, which is corporate profits. So when you start lifting corporate profits, corporates start thinking about investments. When they do investments, they create jobs, they create wages, and you create consumption. And that's a virtuous cycle. That blows up when you get excess investments, when you get reckless investments, like you got in, say, 2009, 2010, to some extent in 2007 as well. So it does happen. Cycles don't last forever. So at the fag end of the cycle, investments become more irrational and bank lending zooms and we, when we get ready for a downturn. But this is a more workable model for India. And we have switched back to this model. This was the model that was in place between 1999 and 2004 during NDA 1, which actually sowed the seeds for the profit boom that we saw in the subsequent period, helped, of course, by some tailwind from global factors. We do have global factors supporting us, not to the same extent as that time, because that time, remember, global growth averaged 5%. We're unlikely to get there. But we still have some support from global factors. We have domestic policy that looks very strong. There are other things that are supporting India. It's something we call as the multipolar world. The world is shifting away from its bipolar position that it has held for almost 2 decades, where China was the main producer and US was the main consumer, to a more multipolar world where production is getting more diversified, where incrementally multinationals are looking to move away from China, and consumption is also spreading away from the US into other areas like Asia. India is sitting in a very, very good position. It's a place which has got a ready market, and it has got a place where companies will want to set up production facilities. Hitherto, they were frightened. They were frightened of doing greenfield in India because it was tough to do business. The production-linked incentives, I think, really changed that, because that it throws a monetary incentive, a real cash incentive after you to invest. And I think it will make a change. So there is a big capex cycle coming in India. You want to buy cyclicals, you want to buy industrials, financials, discretionary consumption over, say, globally facing sectors or the defensive sectors like consumer staples.
Ridham, so if one looks at the market, HDFC Bank is underperforming State Bank of India, and suddenly PSUs are outperforming, a lot of other pockets because they are cheap and they are under-owned. So do you think markets have taken a decisive turn towards the so-called value stocks?
I don't like the description of value. In stock markets, you only invest in value. Okay, value is defined as something where the future cash flows, the present value of the future cash flows, which is essentially dividends for equity shareholders, exceeds the current price. Okay, there is no other definition of value. Low price to book, low price to earnings are nothing but another way of stating the same, which is the share price. They do not signify value. So we have to be careful about describing something that is carrying a low multiple as value. So I distinguish this as deep value and cheap value, and I always prefer deep value, which is stocks that are trading at a discount to their to the present value of the future cash flows. So that is one thing to keep in mind. Rotation keeps happening in a bull market, because what happens is that investors chase, market participants chase underperformers, and they keep playing catch up. That is the characteristic of a bull market. In the bear market, the opposite happens, which is participants come after the winners and try to bring them down. But in a bull market, it is always catch up plays that keep happening. Now, there are two ways in which you can approach this. If you are a trader, then you want to play these rotation trades. If you are an investor, then you want to invest in solid businesses which are trading at reasonable valuations and let the whole bull market play out. So it depends on how you are approaching your stock market business. A trader should definitely look at these rotation trades, and there will be big ones. They're not going to be small ones. These are going to be big moves, 20, 30, 40% moves. There's a huge amount of underperformance that has taken place in a lot of these stocks, and there will be a big catch-up that has to happen.
What is your view on metals? Again, the street earlier was unified that metal prices and metal stocks will go higher, but suddenly lots of differentiated and lot of new views have come on the metal space. Some are saying China will slow down. Some are saying don't worry about China. US will continue to consume after the new Biden program.
There are policy factors that affect metals. China is tightening at the margin. China is also encouraging more production to be sold at home, so that lifts export pricing. So there are contrasting features out there. I think investors at the margin should focus on volume growth. My view is that volume growth will start picking up as the economy starts turning, and that should support earnings. So I think metal earnings should remain strong in the foreseeable future. Now, some of this is already in the price, but not all of it. So the stocks may have more upside left. I would prefer cement over metals, a pure domestic sector where there is no policy challenge from elsewhere, which will depend completely on India's own demand situation. And I think cement is a sector where we've not really seen much capacity addition over the past few years. So when the volume growth breaks out, which I reckon it could in the next 2 years, you will also see pricing power transfer to producers. So that could be a more exciting sector with a 2-year view than metals. Doesn't take away the point that metals may still have some more upside left.
Rhythm, on the extreme side, there are a lot of startups which will be going public in next 3 to 6 months. Paytm is planning its biggest IPO ever, which Indian markets have seen. There is Zomato, there is Naukri, there is Nykaa. So what is the right way of looking at this market? One side we are using the word like re-rating of corporate banks, PSU stocks and metals. And on the other side you got these companies which in a sense are the startup world. They do not follow traditional models. They are also hitting the primary market.
So Nikunj, that's good for investors, right? The choices are going up. For almost a decade and change, we've really not had new business listings in India. And for a lot of investors, that was getting very boring to keep looking at the same companies. I think it's very exciting to see new companies come to the market. It offers more opportunities for
I think we've lost Rhythm there, have we?
the end of the bull markets, ones that you want to certainly avoid. But these are not in that stage. We are very early stages. So a lot of these issuances, I think, will be very exciting opportunities for investors.
Right. Rhythm, where, if I look at the real positioning of the mid and the small cap space, Rhythm, the shape of the economy is such that right now big businesses are getting bigger. Now that is a distinction. That is a big, differentiating factor between the 2004 and the 2020 or 21 bull run. That time, mid-cap companies were able to adapt to the conditions of low interest rates and high commodity prices and increase their balance sheet. This time it's different. Mid-cap companies are genuinely getting crunched because of efficiency and because of the shape of the economy. Do you think the mid-cap rally, in a sense, is slightly overextended? I love your report where you say that suddenly investors are renting the stock and they are not buying the stocks.
Yeah, I think that's a good point. Let me talk about that first and then come to your mid-cap point, which is that the average holding period for the average market participant is down from 10 months to 5 months. The market participant is still holding stocks long enough to see its quarterly earnings, but not long enough to receive dividends or annual reports. The investor in the market is still holding the stock long enough. So this is essentially because intraday trading volumes have gone back to the '07 levels. And it's something that we need to keep an eye on because if such speculative activity keeps rising, then it does put pressure on prices eventually. So we're keeping a close watch on this, and we don't want holding periods to go down to say 3 months like they did in '07, which means that investors are not even waiting long enough to see quarterly earnings and essentially renting stocks rather than investing or even trading in them. I mean, just simply renting them. On your point on mid-caps, Nikunj, the mid-caps that are listed on the exchanges are not small companies. When we say that large businesses are gaining share, it's really against micro and small enterprises which do not occupy any listing. They're not in the listed space. They're really small and micro businesses that got disrupted as a consequence of a lot of reforms that happened in the last 5 years, starting with GST. And they obviously are taking time to respond to these changes, these fundamental structural changes that have happened in the economy. And in the meanwhile, larger businesses have failed. Now, the larger businesses got a even bigger fillip during the pandemic because they had greater, power to withstand the fall in demand, and smaller businesses got hurt even more. Going forward, if economic growth does normalize, as I think it could, and we go back to trend, it will actually lift the smaller businesses much more than larger businesses. And as such, smaller businesses will outperform larger businesses. Again, not very different between '04 and '07, we got the same thing. So if you ask me for a 3 to 4 year view, I think small caps will measurably outperform large caps. But on a 6-month basis, just given the amount of price momentum that is already in the bag, I would favor large caps over small caps. So 2 different views for 2 different time frames. The rest of the year, I think I would quietly shift away from small caps into large caps or balance my large cap exposure. If I take a 3 to 4 year view, then I think small caps have still some distance to travel relative to large caps.
We've covered a lot of ground today, but just two last follow-up questions. How different do you think the market reaction this time will be from when market started adjusting to the first wave recovery? Because this time the market reaction is very different. And are markets prepared for the third wave? I'm just bunching up two questions into one.
I don't know whether the markets are ready for a third wave. What will determine the market's response will be how governments react. Very clearly, the government was not interested in damaging the economy during the second wave. If that response stays put, then the market may not react adversely to the third wave. Also, Nikunj, let's remember that, we don't know when and if and when a third wave is coming, but hopefully by then we will have a much larger population vaccinated. Now, whatever scanty data I have seen with respect to the second wave, the vaccination does provide some protection, even against the new variants, the Delta variant. You can see that in the demographic of fatalities in Mumbai and Chennai. There has been a measurable fall in the percentage of fatalities above the age of 60. That was the cohort that got its first dose in March. And they did not succumb to the virus in April and May relative to the age group below that, so less than 60. So the vaccine does provide some protection. So some reasonable percentage of the population, in my view, will get inoculated. But therefore, the third wave may have different textures to it. Then again, the market knows that these waves come and go. They do not necessarily leave a permanent damage on the economy. So it's a lot more informed than it was in the first wave. And that's how it reacted in the second wave. At the time of the first wave, we had no idea of what was going to happen, how long this was going to last, what would be the fatalities, what would be the impact on the economy. So there was a lot of guesswork going. Now it's a little different. So I don't know about whether it's prepared or not, but I think the circumstances look different. The market, I think, comes out of the second wave. It's already out in the sense. Market is already out of the second wave. And I think we should expect a pretty strong bounce in the economy this month and more likely next month. And as the vaccination progresses, I think activity will normalize far more quickly than what people may have thought, say, 2 months ago.
Just to wrap it up, Ridham, every time we get into a long format engagement, we always talk about trends. And just to refresh memory for our viewers, Ridham spoke about how there is going to be a decisive shift towards EVs because of the pollution levels, and I think that is visible now both locally and globally, or whether it is the ethanol blending plan. What is that next big thing for next 5 years, something which where you can count the tea leaves?
I think the Indian economy looks poised for recovery to trendline growth. And I think people will underestimate what that means in terms of incomes. There's a massive transition happening in consumption because we have the lower level of the pyramid that will actually rise. And what the lower pyramid does right now is spend bulk of its income on staples, on housing, that is shelter, food, and clothing. When it comes out of that and moves into the next year, it will start consuming stuff that it has not ever consumed. And we will be surprised on the upside of how those demand trends shape up. So I think that's one thing we need to keep in mind. Just to recap the numbers, India's per capita income is a paltry $2,000 right now. We think it could double to $4,000 in the next 10 years. And that completely alters the consumption basket. I'm not sure whether that's priced into stocks and whether people are actually thinking about that. The second, of course, is technology. There's going to be continuous technology disruption. There's nothing unique about it. We've been in a technology disruption since the scientific revolution unfolded in Europe about 400 years ago. And successively, a lot of our, a lot of the ways in which we did things have changed. The horse carriage movement being the most famous one from the late 19th century. A lot of those things may evolve and change. We're seeing that in some of the new businesses that are getting listed. They are reflecting the changes that are happening as a result of technology. The interesting thing, though, Nikunj, is that I'm seeing a lot of these so-called brick-mortar companies responding now and building technology platforms, trying to create an even playing field with the new emerging technology companies. And that is the shift that has happened during the pandemic. I think pre-pandemic, companies were not thinking about doing this. Suddenly they were forced to do it. They were forced to build e-delivery models. They were forced to deliver online. And that creates an interesting, I think, situation over the next 3 to 4 years. So let's see how that unfolds. But very exciting times in my view for India as well as stock market investors in the coming 3 to 4 years.
Fantastic. Good luck with the conference, and let's hope we get to meet very soon in person and enjoy that awaited cup of coffee.
Thank you, Nikunj. Thank you very much.